Welcome back. It's a Thursday morning on Squawk Asia. Now, CNBC was the first to report the news overnight. Bank of America boss Ken Lewis has resigned. BofA has confirmed he will retire by the end of the year. The board says the search is now on for a successor. All right, let's bring in Stephen Wood, Chief Market Strategist at Russell Investments, live out of New York. Staying with us out of there also is Rachel Ziemba over at the RGE Monitor, and here on set at our Asia headquarters is Jim Rogers, our guest host, of course, from Rogers Holdings. People, good evening and good morning, wherever you may be in time zone-wise. Steve, let me bring you in on this. As far as the markets are concerned, we're coming off a pretty decent quarter. Over the next couple of days or so, we've got a slew of data on payrolls on Friday. That's the big risk. What sorts of numbers are you looking for?
Yeah, I think the numbers are probably going to come in reasonably in line. You saw the ADP numbers, which are tracking a little bit more close to the actual official jobless numbers coming out. So it should be within that ballpark of the ADP that we saw. And I think that the markets, are beginning to price in the fact that, 2 years ago we had a market that was priced to absolute perfection, and 6 months ago we had a market priced to Armageddon, and we've recovered to something in between. So I think the recovery rally that we've seen, the global economy has begun to engage. And I think, Marty, we're really looking at a transition phase here. We're transitioning from recession into growth, but it's going to be slow growth. And I think, from a corporate story, at least in the U.S. and in the industrialized world, we're transitioning from what was an earnings story in the middle half of this year. And as we go into 2010, I think we're really moving into a revenue story. So I think the market's beginning to price in what will the revenue numbers look like, not just earnings, but revenue, as we go into a growth that is very slow and tepid for the foreseeable future.
But, Stephen, what's going to cause the growth in 2010? I would be more worried about a setback in 2010 or 2011. I mean, they've stopped the cash for clunkers. They've stopped the housing boom. The housing money will stop soon. What happens next?
Well, I think you're right. I mean, guardedly optimistic is my most optimistic state in any market cycle. And I think that's where you're going to see some chop coming into 2010. We've got all these liquidity provisions, these massive balance sheet issues that have been taking place, coordinated globally. And I think right now what we're looking at is data and an economic recovery that's on government life support. And I think the real interesting issue on a case-by-case, corporate name-by-corporate name basis is going to be as the Fed begins to withdraw, tube by tube, that life support that they're providing, what companies stand to benefit. And it's clearly not going to be all. But, Jim, I don't think this is going to be a brisk recovery in the United States. What we've been talking about with clients is that Chimerica recovery. China leading in terms of sequence and leading in terms of, new growth. And the United States kind of following. So I'm under no illusions that it's going to be brisk. But we want to find out who the names are that can benefit as we move out of that life support system.
But, Stephen, China is 1/10 the size of the American and European economies combined. How can China lead Europe and America out? It's 1/10 the size of Europe and America.
Well, I think we'll look back at the data that in the beginning of this year that the Chinese growth story started. And I think for in terms of driving the growth in the United States, I don't think that's going to be the case. I think they're going to lead in terms of having gone first. But I think the stimulus, I think the inventory cycle is enough to get us above zero going into 2010. But talking to clients over the last couple of days, I think anybody who's anticipating a V-shaped recovery is going to be disappointed, and they're going to be disappointed for a while. So with a consumer who's not dead but damaged, with a government that is spending, and I don't want to get into a political debate right
well
now,
beyond its means,
but I think you're also beginning to...
Government spending well beyond its means. But anyway, go ahead, Steve.
Yeah, correct. So I think you're creating, going into 2010, modest positive growth. So it's going to be a challenging environment, and I don't think we're going to return to the easy credit of 2006. Right. So this environment, I'm calling this the post-Lehman jump condition. We've kind of moved into a new set of ground rules for investing. And
Indeed.
So as the Fed withdraws, I think there's a lot of opportunity to assess the environment in 2010.
All right, we'll talk about some of those opportunities in what's being called the new normal coming up with Steve and all our other guests coming up in just a bit. Quick break here on Squawk Asia. Again, questions for any or all of our guests, you know what to do. Email us at squawk@cnbcasia.com.